All right. Well, let's go over it. A good client or a bad client?
Terrible client.
Yeah, and by the way, this is one of the reasons why the AICPA gets so over the top about who you associate with. You know, that the integrity of a client is the most important thing. You know, if they have other things going on, you know, that's fine. You know, if their company's not doing as well or whatever, but the integrity of the client is, you know, the most important thing. And just kind of shows why. Okay, so they thought to give the guy running the place gave unaudited financial statements to an investor showing profits of 1.9 million. They actually had a loss of 500,000. And by the way, the importance here isn't just the swing of what, 2,400,000. The difference between a company that's profitable and one that's not is huge. You know, so you know, even though it is, you know, significant dollar amounts, it's also that a profitable company. You know, if it was 1.4 million instead of 1.9, it wouldn't, you know, it wouldn't be as big of a deal. But because it shows a loss, that's huge. Okay. And they said, let's discuss some options, but MedTrend rejected all of them. Went on to say, you better not query my deal or you'll be sorry. You're finished. You're going to finish this. So this is where the fun happened. The firm withdrew, and they retained two other CPA firms. Both of either were discharged or withdrew from the engagement. Only a third successor. So this is the fourth CPA firm came in, issued an unqualified report that had the adjustments that Deloitte had proposed 3 auditors ago. All right, go to court, and MedTrans won. You say, why? Why in the world would MedTrans win? It has to do with professional standards. And there's a whole group of law for professional standards. And as a CPA, you are considered in this professional group, just like doctors and lawyers. You're given a monopoly on doing things, in this case, auditing. But that comes with some strings attached to it that you have more obligations to your clients and to the public because of that. You know, so it says down here, professional responsibility that a CPA could not under any circumstance withdraw from an engagement if it unduly jeopardized the interests of the client. That was the ruling. And you say, well, that seems really unfair. But it's sort of like this. If you had a doctor, let's say a doctor, and they're going to go in for a normal routine operation. So they bring someone in, doctor opened up the patient, and, oh my gosh, there's a whole bunch of other stuff going on. Doctor, you know what? I didn't sign, I'm leaving. The doctor runs out of the room. You can't do that. You know, if you're a doctor and you have to do everything you can to whatever whatever the operation is or whatever. So, you know, in medical terms, this may be a little bit more rational, but you know, that's, you know, those are kind of the rules that you have a responsibility to your clients that goes above and beyond, you know, what you'd normally think, and that's where they were caught on this. And this was kind of the rules for, you know, however long, you know, a really long time. It still is. So, you know, anyway, so MedTrans won. The jury awarded the company nearly $10 million. And this is where it got really strange, is that the Court of Appeals reversed the decision. And this was a big, big deal when it happened. that holding judges should instruct juries about AICPA standards which authorize withdrawal. And I think because this was kind of like such an injustice, I think that's probably, if I had to get in the mind of the appeals court, that's what it would probably be. And by the way, this case has stood up. So this case has been cited many times, especially when dealing with clients that are unreasonable, and that looking at the professional standards, that those can be instructions given to the jury that this is how, as a professional, you should behave. And the idea too is that a lot of these professional standards are not only there for this client, but for all clients. For a CPA firm to have to be, kind of beholden to a bad client that would, denigrate other clients that are, associated with CPA is a bad idea. So what does the med case do? It says that they duty care based on professional standards rather than the rules of law. So it is possible. They didn't give any other instructions other than that, but you would use professional standards instead of this professional law that's established in, all states have it. Now, it's not to say that you can get completely out of professional, there are some professional law cases that will still stand, and they didn't say throw out all the professional, standards cases. But what they did say is that you can use the standards by whatever the governing organizations are, or the organizations, for instance, like the NASW. They're the ones for National Association of Social Workers and things like that. So now, again, this is some of the stuff in the AICPA turns out become state laws. Some of them do not, and those are kind of the gray areas. And this is, those are probably considered one of the gray areas here. So you still have to be careful about this. Now, there is something about this that Deloitte & Touche. Now, Deloitte & Touche, everyone would thank them for this case, because this case, brought about a good change, basically, especially for auditing. When the case is, something's jeopardized because of the client. What could have the CPA firm done instead of withdrawing from the case? This is what they really got hit with. This right here. When they withdrew from the case, that was when they were really on shaky grounds, especially, this is before you could use professional standards. But what could they have done instead of this? Instead of withdrawing from the case, they could have stayed on the case and did what? What were they hired to do? What could they have done that would have avoided all of this? And I'm telling you this because, if it goes to, anytime a case goes to court, you're probably losing money on it. And I'll tell you something else about being in any kind of job. If the company loses money, if the firm loses money on something you did, they're not happy. They're quirky that way. But anytime something gets drug into court, whether you win or lose the case, it's probably going to end up costing you money. But what could they have done instead? They could have just completed the audit and gave them an adverse or a qualified opinion. Or I should have said the new terminology is modified. They could give a modified opinion or a adverse opinion. You know, they could have finished the audit and just did that. You know, there's nothing that the CAO could tell them to do that would make them change their audit opinion. They could have done put their audit opinion on whatever it was. They didn't have to come to an agreement with this person. So you gotta be very careful on stuff like this. And I would say you'd still, sorry about that, causing me, something's wrong here. Anyway, so you know, there are things and so when stuff like this happens, I think what happens a lot of times people get to pounding on tables and saying, you're wrong, you know, so. And by the way, you do run into bullies every now and then. If you go into auditing, you're bound to run into bullies. They're people that are just part of the business. You know, it's just part of the way things are. You kind of used to dealing with. You get all sorts of people. You get people that are really nice. People that want to be your friend. You get people, and you run into bullies. So anyway, and so this is not that a person running into somebody like this is not that unusual, I guess is what I should say. So what's the importance of the MedTrans case? Anyone? Oh, come on, we just discussed it. Remember, I was there, you were there. Car was there.
It kind of gives auditors an out if they have like a good reason to leave the engagement.
Yeah, and that's absolutely right in this case here. This case kind of demonstrates that, and this is again, this case means quite a bit. Yeah, and that you can use AICPA standards. That the AICPA standards sometimes can be used instead of the law. It's unfortunate that they have professional standards because the professional standards are for all professionals in the state. You know, professionals are doctors, lawyers, CPAs, therapists. There's a bunch of other ones. There are standards as being a professional, but these professional standards by the AICPA rules can be used instead of the standards, and that's huge. You know, in the past that was ironclad. You could not get around the standards of being a professional for getting a license. Those were set in stone, and this said no, they're not. And again, and this was picked up all over. So this is one of those cases that gets cited a lot. And it also does another thing, and that is, you know, I think I told you this before. I know I've told you this before. Some of the AICPA standards become state laws. States look at those AICPA standards and, you know what, that'd be a good law. And so then they would implement it. Well, this says they don't even have to do that. If the AICPA is a standard, it's possible that could be used in court, whether it's part of the state law or not. So it's actually a very significant case that sort of gives the AICPA. Now remember, the AICPA is just this club. It's like the Boy Scouts. But it gives them a kind of a clout that, you know, even if the state has not adopted what they say is law, that it could be used in a court of law. And that's huge. You know, because in the past, you go into the court and they say, well, this club I belong to says, and they say, well, yeah, we don't really care about your club. I don't care what the club's name is. You know, it doesn't matter. But this says no, professional standards by professional organizations can be used instead of state laws. Yeah, it's a big deal. So anyway, all right. Well, let's go on to so tonight the MedTrans case, and then we'll start the cost receivable handout. And I sent this out, I think, last week, but we never got to it, I don't think. And the reason I go over some of these documents is a lot of times you're taking the CPA exam, they will throw names for stuff out there. And it's kind of they expect you to know. So that's what the kind of going through some of these things and kind of the order of how they go through. Okay.
I have notes up until letter H.
Oh, really? We did this?
Yeah, the last thing I have was pledging of accounts receivables, and I have that filled out.
Oh, okay. Well, what was I doing? I'm sorry, I do have it. Hold on. Hey, look at all that. Okay. Oh, yeah, right. Okay. Yeah, the confirmations. And I think I jumped ahead too, didn't I? No. I can't remember. Okay. Regardless. Well, we're gonna have a short class tonight because this is all I have here. I should brought up the other one. Okay. Confirmations. I hope you guys are okay with having a short class.
I mean, if we have to.
Okay, positive confirmations. These are confirmations that you send to let me put something in here. So these are sent to the client's customers. So they will have this list of accounts receivable. And they'll have customer names by it. And so you want to know whether these customer accounts, some things about them, whether these are accurate and, whether this customer exists and all that kind of stuff. So these are confirmations. These are sent by the auditors to the client's customers. One thing I wanted to show you guys is that auditors only has 1 hour. I hope you guys are paying attention there. Okay, so you're sent to, and because the auditor wants to know, are these real accounts receivable? So these are confirmations. We're talking about for accounts receivable confirmations. These are sent to the client's customers. Okay, so the people that they sell stuff to, it is sent to them and saying, do you owe this money to them or not? Okay, positive confirmations. All confirmations must be returned to the auditors. So if you send out 100 confirmations, you got to get back 100 confirmations. Send them all out, you get 87 back. You got to start making phone calls. You guys have received that confirmation? Oh yeah, it's right here. I'm looking right at it. Okay, can you send that? Like, yeah, sure. Then you get 93, and you make some more phone calls. You finally get down to 98. Do you have a fax machine? Yeah. Why don't you just fax it over? Okay. Okay, I'll get that this afternoon. No, I'll do it right now. I'll sit here. I'll be by our fax machine. Do it right now. Like that. So all confirmation must be brought back. Now, the invoice they really come in two different forms, although I'll talk about this in a second. Invoice confirmation, usually you have the invoices on there, invoice, because a lot of times customers have put in more than one order. So the invoices for, wherever the orders were. The ACCP, I have no idea. I've never seen these before, but they also say blank confirmations, where you send out a confirmation, a blank confirmation form, and ask the customer to fill it in. You can imagine what I can imagine what happens with that. 0, send it back. But the ACCP seems to think that's a better one. I've never seen those. I don't know if anyone's ever used one. I've talked to other auditors just because I see it on the CPA exam. Blank confirmation is they've never seen one. But anyway, they still include it. And so in the CPA exam, if they talk about a blank confirmation, supposedly that's the best because that comes exactly from the third party. Although I think the information would be a little bit, not as reliable. But anyway. Okay, so you get all these confirmations. So if everything's okay, they send it back. If everything's not okay, they send it back. Which ones are you worried about? The ones that are okay or the ones that are not okay? Are you worried about the customers that they have that say, yes, this is exactly correct? Are you interested in the customers that say, no way, this isn't right? Which ones are you interested in?
The latter.
Yeah, the bad ones, right? You have the good ones and the bad ones. The ones you're interested in are the bad ones because other ones that say, no, this isn't right. That's a negative confirmation, so that only negative confirmations are returned. So you say, well, here, let's see. I think I have an example of both of them, don't I? Yeah, okay. So we'll go down here and just take a look at them. So a positive one means it has to come back. And you have to do some work to get them all back, most likely. It could be people just send them back, but a lot of times they don't. Okay, so a positive confirmation. First thing to notice is this will have the client's letterhead on it. Why don't you put the CPA firm's letterhead on it? So for instance, if this was for IBM, you'd have IBM's letterhead on this confirmation. Why don't you have the CPA firms? Why don't you have, Deloitte and Touche or whatever it is?
Then another client.
Yeah, exactly. The customer said, I don't have any business with you. They do have business with IBM, and that's what you're trying to get. So these will be sent out usually on the client's letterhead. And as far as what you show on there, a good thing that they'll, a lot of times they'll always do is have the, I have the different invoices. So here's this, here's the invoices that we have for you. And here's the total. It's possible if it ends up being somewhat confusing for the customers, the accounts receivable customers for the client, you can send these out with just one on it. And the idea is if you get, if you send out 3 of these to 3 different people with 3 different invoices, that you get the same amount of information out there. And quite honestly, if you put too many things on there, they may not look at it. Do you owe these these amounts, whatever? And you wouldn't put a total in. You'd just say, is this invoice appropriate? So it is possible you don't put all of the invoices on. But the classic way to do it is to put all the invoices on, say, this is their accounts receivable that they have on the books. They have 36,265, blah, 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 on the books. And we want to know if this is correct. And so they will say yes or no. You know? And you say, okay, well, if it's if it's no, ooh. If it's no, you just blank it out. No, you don't. So if it's no, then you tell them, well, what's wrong? Why is it, no, this, we returned this stuff on in September, whatever it is. So then they'll write in here, what's wrong with it, and send it back. And we're going to find out later that those returned when they put stuff down on there, then as an auditor, you have to do what they call clearing those, figuring out what went wrong with it. Okay, so, if they say, no, that this isn't correct, okay, then you have to figure it out. Okay, why isn't it correct? Okay, they said they sent this back. Do you have a receiving report for this or whatever it is? So, they'll send this back. And again, this is a positive one. So all of these will have to be returned. Send out 100, you got to get back 100. Okay. Now, the negative one is similar. It says we have the following invoice. Is this amount correct as of yes or no? Take my little oopty thing down here. And if they say yes, yeah, that's correct. Yeah, we owe that. If the amount indicated above is correct, please disregard this confirmation letter. If it is not correct, then just like the other one, if it's not correct, tell us what's wrong with it. But if it's correct, you disregard it. So this is a negative one that it's only returned if there's a problem. If there's not a problem, throw it in the garbage. Okay. Notice something about this negative confirmation, though. Are you going to start calling up their clients to see if they had it? Did you get it? You got to turn it in, that kind of stuff? No. The whole idea is that they don't return it if everything's fine. What could be the problem with a negative confirmation?
I mean, let's say it gets lost in the mail and they never saw it, and you assume that it's correct because they never answered. So, and in reality, it's not accurate or correct.
Exactly. Maybe we sent to the wrong address, the old address or whatever it is. Yeah. You send it out, you don't get it back, you think everything's okay. You also don't know what they did with it. Somebody must have opened it up. Oh, this is stupid. Those guys are idiots. It throws it in the garbage. You think it's okay where it's not. So you don't really know. You can't really get any kind of information or comfort, however you want to put it, on those that you don't get back, because you don't know why you didn't get them back. Maybe you're going to the wrong people. They may not have paid attention to it. They may have just thrown it out, just routine, not even looked at it. They may have, whatever. You don't know what happened to it. It may have got lost in the mail being sent back to you. You don't know what actually happened to it. So you can't really get any information. The only thing you can get information from are the ones that are returned. Okay, so which one of these are better? The positive confirmation or the negative confirmation? Which one is better evidence?
The blank one.
The blank one, good answer. The blank one's the best. The positive one with that's by the ACCPA, by the way. which is what you should be. Forget about what I say because it's not going to matter. The blank one's the best, where they would just have lines here saying what amounts do you owe. This would be the next best one, and this is one that you'll probably see virtually always. Is this one we have the invoices? This this invoice, that invoices. The positive ones are going to be the more accurate, and these are the ones that are going to, because you will go through and get all of them back. These are the ones you're going to get a little bit more information on as far as what's actually going on with it. Okay. Well, you say, well, okay, well, if these are better, why do we even have the negative ones? Why have the negative ones around? These are much more.
You have a lot of clients with just small account receivables.
That's exactly right. Yeah. Do I have that down here? Yeah, I'll put it up here. Yeah, usually this is kind of how they break these down. The positive confirmations are generally for few accounts receivable and large dollar amounts. Oops. I don't know why I'm writing capitals, but anyway. So few accounts receivable and for large dollar amounts. And you imagine if you have accounts receivable for millions of dollars, you go, okay, well, we're definitely going to have to confirm those because one account could be material, right? I mean, if you have customers that have 5 million in accounts, the accounts receivable, okay, those are big numbers. We got to confirm them. Negative ones are when they have a lot of accounts but small dollar amounts. Try to this up a little bit. Sorry. So negative ones are for many accounts, small dollar amounts. So that if, one of these accounts receivable or even several of these accounts receivable, if they weren't on the books, it wouldn't be material anyways. You don't want to have to call around, to track down a $15 accounts receivable. Probably spend more than $15 trying to do it. So, the small dollar amounts are generally not worth it, to go through. So if you have a whole bunch of accounts receivable, you can send it out. And what do you get back? When you look at what people send back and, the number of them that you get back and what they're saying on it, you can find patterns that might be happening. Well, they charged me for shipping twice or whatever it was. Those kind of things you get back that you could actually get some information of. You do not get any information from the ones that are not returned though, because again, might have got lost in the mail, going to or coming from. They may not have taken it seriously. And by the way, another thing about the confirmations is that you would only use these if their customers would take them seriously. If you believe that the customers will take the time necessary to fill them out. If you don't think their customers are going to take time to fill it out, there's no reason to send them. Now that's from the AICPA, but there's also a twist to that. Yeah, I think I have it in here somewhere. Maybe I don't. Yeah, I do have it on there. So any question on that? Okay, there's also the idea too, and I'll put it down here somewhere. Yeah, you guys write this down. I think I showed this to you before. I'm not positive though. Let's say that you have positive. Oops. Positive confirmations. And let's say that you want 100 of those to be happy with your you want to get at least 100 of them to be certain of your or whatever to get the warm fuzzies, as my one audit supervisor would say. To get the warm fuzzies, how many do you need? Now, if you instead use negative ones, there's nothing wrong with that. Now, negative ones aren't as good. So if you're trying to decide whether you should use positive ones or negative ones, would you need more negative ones or less negative ones to be just as happy? What do you think? So positive ones are better, but you're also contemplating, well, maybe we should use, maybe you got, these accounts, maybe they're not really big, but they're not really small, maybe they're like a couple $1,000s and, up to tens of thousands of dollars. So it's not like they're peanuts, but you're trying to decide between positive confirmations and negative confirmations. And you decide, okay, we'll be happy if we have 100. If you're using negative ones, we need to have more than 100 or less to be just as happy.
I mean, a lot more.
Yeah, right. They're not as good, right? So if you're looking to, to say, okay, well, if we use positive ones, we'll get 100. If we're using negative ones, well, we're going to have more of them. And let's say that the cost each to the auditor. So every time we send out these 100 ones, on average, they cost us $20. Negative ones are cheaper. We don't have to call them back. We don't have to track them down, all this other stuff, sit by a fax machine, all that kind of stuff. They cost us $3 each. Which one should we use? The positive ones or the negative ones? You're just as happy either way.
The cheaper ones?
Yeah. Another thing about auditing is you do not always need to take the best evidence. It might be too expensive. And two, don't forget that, when it comes down to it, in the end, this is the client's money, right? I mean, they're paying for the audit. So you're sort of also somewhat obligated to try to do it as efficiently as possible. So it is possible you say, okay, well, I know that the negative ones aren't as good, so we need a lot more of them, 5 times as much. But it's cheaper to do that than to get the positive ones. So even though, there are ways to use either of them, it is possible you take and this goes for all evidence. It is possible you take the not so good evidence if it's cheaper and you can get to the same level of confidence. Now, if you can't get to the same level of confidence with the negative confirmations, then you shouldn't do it. But if you can, you say, okay, I'll be just as happy with 500 of the negative ones, as it was 100 of these. Maybe you figure you get the same amount back that are, negative as you would from these positive confirmations. So it is possible that you take the negative ones, even if you could take the positive ones, just because it's cheaper. Nothing about evidence though, and not just for this, but that you do not have to take the best evidence. It's not required. You have to get to the same level of whatever you're auditing to. But okay. These are a little bit kooky. Now, for whenever you come into these assertions, quite honestly, you could do almost any of these would be valid answers. You're talking about the assertions for confirmations. The AICPA, when they give you the exam, they will say, pick the best answer. So when we go through these assertions, these are the Pcaob assertions, by the way. They're very similar to the AICPA. Which assertion is by the accounts receivable confirmation? Which one is probably the most the best answer here? And again, in a certain way, all of them come into play. But which ones are probably the most direct as far as the accounts receivable confirmations? Be wrong once. Don't hold back. First thing you can do on the CPA exam is you can actually flag questions and then go back to them. I always tell them the worst thing you can do is stare at a question for 5 minutes, because you might miss questions that you could have gotten. So make a guess, flag it, come back to it.
Is it E?
E's not bad. I say that's probably the second one. The valuation. That's not a bad one. There's one up here that's probably the best. When you get a confirmation back, what does it prove? They may change the numbers on them or whatever, or maybe they send back a clean one saying, okay, everything's fine. Okay, what does that tell you?
So then B, right, that it occurred?
Yep, this is what according to the AICPA, this is going to be the one that is probably the most. Now, valuation, absolutely. You'll go through and see if especially if there's a pattern of things that are incorrect on them. But the existence, it shows that they exist. The dollar amounts may not be right, but this is a real customer, right? So probably the most important one there is that this is not a made up, a fictitious customer, especially if they send back a negative one, because they say, okay, this is somebody, not only a customer, but they, they're mad. So, yeah, so existence or occurrence. The problem with evaluation, there's actually a couple problems with evaluation. First of all, sometimes they will lie. I mean, we don't owe for this, when they do. Another thing is a problem even with the normal positive confirmations. If you send this out to them that they owe on these 3 invoices, Maybe there's 5 invoices, right? I mean, it'd take a very honest person, and hopefully we're all like that, to say, I actually owe more than that. I owe, $10,000 more than that. So there is the problem too that, that this is not very good at understatements as far as the accounts receivable. That if this is 36,000 and it really should be 48,000, you're probably not going to get that from the confirmation. So the valuation of it is a little bit dicey, although it will give you, especially if you find patterns that, oh, this is being double charged, or this is, whatever, they're charging the wrong amounts for this or that. Then you say, okay, well, you're charging too much for this one product or whatever it is, or shipping or whatever. And that you might be able to make a correction on a number of accounts based on that. It'll tip you off to where to look, But existence or occurrence is probably the most, at least by the AICP, that's what's going to be. I threw some of these other things in here. This one's kind of like who's in, especially nowadays, who's in Grant's tomb, who's buried in Grant's tomb. Which assertions are aided by the cutoff procedures? Oh, come on. Yes, it is that easy.
I mean, the completeness and cutoff.
Yeah, this is probably the most important one. This one again would probably be, the valuation. So valuation of accounts receivable, of inventory, all that kind of stuff would also be in there. The cutoff procedures used to be included in there. It also has to do with the existence or occurrence. Did the sale really occur in the year that you said it occurred, and all that kind of stuff. Okay. And again, for the problem with these assertions, a lot of times it's more than one of these will be, the best answer, or not the best answer, a answer. Which sales and accounts receivable assertions are aided by analyzing the cutoff bank statement? It's basically the same as this up here. You're really looking at the cutoff ones of what sales are made during the, which year and that. Now you're also going to be looking at for deposits and transit and all that kind of stuff, for cash sales and all that. It's going to be the same as the one up there. Yeah. And again, the cutoff ones, they kind of broke those out separately. Back in my day, they used to be included in the valuation. They would say, okay, what the sales were, also play into the existence or occurrence of it. Did the sale really occur? That sort of thing. Notice too that the sales, accounts receivable, and inventory are all connected. That's another thing that's kind of important, is that sales turn into accounts receivable, right? You sell something and now they owe you money for it. But there's also the inventory portion of it. The inventory goes into cost of goods sold, which is kind of like an expense. But also that inventory that you sell is no longer in the inventory that you have on the balance sheet, right? If you sold that one at the end of the year, then it should be in the, So the cutoff, especially for sales and accounts receivable, also has a big impact on the inventory. It's a very, you get those 3 big things that are going there. The accounts receivable are assets, inventory is asset, sales are money coming in, it's revenue. And then you also have the cost of goods sold, which is like an expense. So you have those three accounts are all tied together. And that's why inventory, if you're wondering why people go so bananas over getting the inventory right, it's because it makes such a big impact on the big numbers in the financial statements. You look at a company like, say, Walmart or Target or something like that, their inventory is huge. A little bit different, a little change in the inventory can make a huge impact on the income and everything else. And another, one of the common things about, when you hear people talk about income is, income is the difference between two very large numbers, the sales and the cost, and expenses. Those two very large numbers. And if one of those changes just a little bit, it can really have a big impact on the net income. So the sales, accounts receivable, and inventory those are really big, can be really big parts of a business, especially like a retail business. And that's why they kind of go so crazy for the cutoff to say, okay, 1 day's worth of sales can be very big. Okay, our accounts receivable confirmations required by U.S. generally accepted auditing standards. Yes. Unless you have a really good reason for not sending them out. So generally speaking, you are required to do it by the US standards. Unless you have a really good reason for not sending them. Maybe you sent them out the previous year and you got 30%, you send out positive confirmations, you got 30% of them back, made a bunch of phone calls, got 42% of them back. At some point you go, okay, this is a waste of time. I'm not getting it. Or I'll tell you that we had when I worked at Navistar, we had an engine plant that sold. We made the diesel engines for the Ford trucks, and we sold something like 96% of our production was to Ford. So our accounts receivable was Ford, basically. Well, it probably doesn't make a whole lot of sense sending out the accounts receivable because it's really dominated by just one. So you probably just go through the entire Ford account and see what's going on with the Ford account. Because if 96% of them are, percent of the accounts receivable are okay, it's fine. So it is possible that you don't do the confirmations, but you have to have a really good reason to do it. It isn't just, oh, we decided not to do it. You basically have to have a really good reason not to. The standards say you must do it. International standards, no. Auditors may verify the accounts receivable in others' ways. So, you may look at getting in checks at the end of, if they have accounts receivable on their books that are coming due, you may look see if they receive checks. Look at the checklist, see what they did in January. On January 5th, did they receive a check for this accounts receivable? That would verify that, okay, it must have existed because they paid for it, right? So there's other ways. You can also look at shipping documents and other things. So there's other ways to verify the accounts receivable. International standards are, and you'll find this generally in the international standards anyways, they're generally a little bit more lenient in that they don't say you must do this, you can't do this, that sort of thing. The US standards are kind of like that. You have to do confirmations. Unless there's some really good reason not to, and you better have a good reason. Whereas the international standards are, however you verify them is fine with us. Just verify them, Question on that? I think we're just going to plow through, but I don't think we'll get out a little early. Yeah. We shouldn't be here too long. Okay. Who should authorize to write off accounts receivable? This is a little bit tricky. Anyone except the sales department? Or the accounts receivable? So it should be someone who is not, intimately involved in the management of the accounts receivable. You don't want the people who are making the sales to be able to write off the account. For one thing, maybe getting kickbacks or something. And same thing with accounts receivable. If they're managing the accounts receivable, they should not be the ones that write it off. Somebody else should write it off. It could be somebody else in accounting who's not associated with it. It could be someone in treasury. It could be someone, but somebody who's not involved directly in the accounts receivable. You don't want them to have the authorization to do it. And like, for instance, accounts receivable, you don't want them to have the authorization to write it off and have the record keeping, segregation of duties. Authorization to write it off and to make the sale. Yeah, the write-off would be the write-off would be more of a almost like a custody of asset thing, that you're giving up the asset. Okay, what's the last of it? Oh, rats. Oh, there's a whole bunch of stuff here. Oh, we already did this one. This is the one we did already. That one was kind of fun. Okay, now for the not so fun one. I forgot about that. Okay. One of the things that sometimes they'll put on the CPA exam is, how do you clear confirmation responses? So you send all these confirmations and you get responses back. And dealing with these confirmations, you're dealing with the public. And dealing with the public, some people are great, some people are not great, some people, you have no idea what they're thinking. So when they send something back, you have to go through and clear it. You have to say, okay, well, let's assume they're correct. How would we figure out what to do with it? So you get to swim back. We never received the last shipment listed. How would you verify that they did? What documents would you look for? Let's go back up to our documents. What document would you look for? They say, we never received that last shipment.
Bill of lading.
Excellent. Bill of lading. Now, you might also look for the proof of delivery, but the bill of lading is probably the most important one there. Why? Because it shows that they actually sent something. It may not have gotten there, right? But it may have sent something. Now, you may also ask for a proof of delivery that you should be able to get from the shipping company. But the bill of lading is a very important document that, well, hey, we sent that out on, December 26th or whatever it was. Here's the bill of lading that we actually sent out. So bill of lading shows that there was a good faith something, in sending it. So bill of lading, and the bill of lading will have a description, not the dollar amounts, but a description of what's on there. So down to here. To clear it, you probably look for the bill of lading. again, the bill of lading, I think, is probably the most important one there because it shows that was at least an honest effort to, that whatever the item was that they sent it out for delivery. It may not have got it. It may have been lost in shipping or something, but the bill of lading on the most important part. If they have a proof of delivery, that kind of seals it. Again, sometimes people will answer these things. Maybe they just don't know. I don't think we ever did that. I got that. Did we? I don't think we did. Send it back in. Okay. Number 2. Well, $3,500 of this invoice had been returned on 12/9/21. What do you do with that? I'll tell you one of the documents I don't think we've talked about too much because we haven't talked about inventory yet. One of them is a receiving report. Did we talk about this? I don't think we did. So a receiving report is when it comes to the receiving department, and that will be one thing that you look at. Receiving report. If you can contact the customer, you might also ask for the customer's bill of lading. Say, okay, do you have a bill of lading for that? Because that would show that they made the effort to send it back, where if they don't have a bill of lading, they probably didn't send it back. So you could also ask for, now you might not, you would certainly clear this with what am I doing here? That's not right, is it? Oh. I figure out how to spell. There we go. See? 7, 8 tries. I spelled a word that we all knew in first grade. As for the customer's bill of lading. Now, sometimes the client may not want you doing that. Look, don't bother my customers. They're already, they're not happy with us as it is. So, don't do that. But a receiving report would show that it was received. If you don't have a receiving report, then you probably have to find some other way of contacting the customer and seeing if they have any information on it, bill of lading, proof of delivery, anything. Okay, number 3. So these were sent out for responses for 12/31. They write back. I already paid this on 1/6/2022. How would you clear this? So they said they paid it on January 6th. What does that say about the accounts receivable? If they paid for it in January, what does that say about the accounts receivable on 12/31? Was it valid or not valid? Oh, come on.
What was the question again?
If they paid it, they paid for it in January. They said, no, we already paid. We paid that on January 6th. What does that tell you about the accounts receivable that they had on their books, your client had on books on 12/31? If they paid for it, it must have existed, right? Must have been.
Oh, yeah.
So this actually, while this may come up as a negative, come back as a negative response and say, no, we paid this in January. This is actually a confirmation that it's correct. Now, you may also look at the checklist. It's possible you look at the checklist to see if they did send it in, sometime after the January 1st. I should say after. So you may still want to take a look and see, okay, did they really send it in? Did they really send the check in? But this is one of those ones that, they take a look at it and say, no, we already paid this. Maybe you sent this out, mid-January or whatever. They say, no, we paid that. We paid that one already. Looks like it's negative when it's really not. Okay, not our order. The entire order from 12/12/21 was returned on 12/15. This was another customer's order. Your company is stupid. What do you do with that?
Go back and see if the order actually existed, or check the bill of lading.
Yeah, bill of lading, and you'd also might want to find the actual sales order. To figure out who actually ordered it. And this one is actually one of the more serious ones here, because this one indicates that there could be an internal control problem. That if they're taking orders and sending them to the wrong people, that leaves the question of, what are the controls over the sales orders if these can actually be sent out to the wrong people? At least they might be sending other things out that never come back, and that sort of thing. That some of these accounts receivable other ones may not be accurate either. So you look at the bill of lading, see that something was sent, and then probably want to look at the sales order and see who it really should have been sent to. It could be a simple confusion of names or something like that, but it could also mean that there's a problem, an internal control problem with their sales, which might have an impact on what you do, as far as testing and all that. My favorite one is number 5. This total seems too high. What would you look at for that? And you say, well, do you really have to clear that one? Yeah. Whenever you get one back, you got to clear it. There's no exceptions made for lack of information. This seems too high. What do you do? What would you look at to see if it, they say this seems too high? What would you verify? First of all, they are proving that there's the existence of the account, right? They didn't say we don't know anything about this. They just said this seems too high. So it does prove the existence of it. So even though this is a negative one, it does prove there is an account there. They don't like the dollar amounts. What do you do? What would you look at?
The sales order?
Yeah. probably the sales order and see what the dollar amounts were. And you would probably also, it's kind of like this one up here. You'd also look at the bill of lading to see what was actually shipped, because sometimes the sales, not everything on the sales order may have been shipped. So you would probably compare the sales, I would say, bill of lading compared to the sales order to see if the sales order, what was actually shipped in the sales order and for what price. And to see what it does. You may also look at if there was a purchase order. For instance, the purchase order may have had a price that was different than what the salespeople put on there. The purchase order should have the prices on it because it should be agreed upon before the purchase is made. Not all the time do they do that, but it should be in the perfect world. So the sales order should match up with the purchase order, or at least where it can. And then compare that to the bill of lading, what was actually shipped, because it could be that they're billing for something that wasn't shipped. My second favorite one, a company run by lawyers. For company policy, we cannot disclose any private information regarding our vendors.
That's what the client is saying.
This is what the client's customers. So one of their customers says, you send them the confirmation.
Oh.
The customer sends back, for our company policy, we cannot disclose any private information regarding our vendors.
I mean, it verifies the account because they are a vendor.
Well, the vendor is your client. Your client is selling stuff to them.
Yeah.
And by the way, even though I say that this is like company run by lawyers, you'll actually find a lot of confidentiality agreements with customers. That you don't disclose what we sell it for, what we buy it for, that sort of thing. It's not that uncommon that you don't want other businesses knowing what you paid for something. So while I do joke about this being a company run by lawyers, you do find those in some of the agreements. When I was at US Steel, they even had, it was like, come on, it's steel. It's like, it's a commodity. Everybody knows what you're paying for it. But yeah, probably, along the same lines, see what was sent to them, verify it another way. And so, the ways you can do it, for something like this, how would you verify it? Bill of lading, actual sales order. You can also look at subsequent payments. So if they have invoices on there that are due in January, you can check on the cutoff bank statement. Or it will probably actually more likely in the it shouldn't be a cutoff bank statement, more likely be in the checklist. So look through the checklist in January. Did they pay for it? If they paid for it, it's probably valid. So subsequent payments is another way to verify those. There are a lot of, and by the way, just going through this is why the international standards say however you want to do it. It's fine. The international standards, if you want to pull a bunch of bills of lading and compare it to the sales order and the purchase order and the invoice, that's fine. US standards, that's not fine. But international standards, yeah, if that's a more effective way of doing it, nothing wrong with it. Okay. Hey, the last problem of the night. Ooh, look at that. Done at least a half hour early. Yay. Okay. We picked this up at will call and paid cash. Oh, does anyone know what will call is? You ever worked at a place that had a will call? Will call is usually for a business that they ship, a lot of times they'll ship stuff all over the world or whatever. But if you're local, you can go and pick it up. So you say, okay, well, you're dealing with a company in Chicago. They say, well, we can ship it to you for $500. Well, I'll just send the guy over the truck, right? I mean, we got the truck. Guy's name's Joe. We'll send him over, and so that's a will call. Is that I don't know how I got the name, but will call, and you go there and you can just pick up your stuff there yourself. So it's sort of like a business to business usually that you go and you pick up the stuff. Kind of like we do now for with COVID, you go there and pick it up yourself. So usually it's to avoid shipping and to get this stuff faster. If you're local, you just go pick it up. Okay, we picked this order up at will call and paid cash. We don't owe anything. And a copy of the cash receipt was included in the return envelope. So here's an accounts receivable that they picked up and they paid cash for it, and it went on as accounts receivable. As an auditor, what are you worried about when you see this? If somebody paid cash and yet it ended up on their accounts receivable. What would you be worried about? You guys, this is the last one of the night. Okay.
It sounds like it was accounted incorrectly if they did pay it, but then it went into accounts receivable.
What's the problem with this? This indicates that they handed cash to somebody. Now, if they put it on as accounts receivable, then the cash that they deposited wouldn't have matched up, and it could be that that's what happened. But the more worrisome thing is that somebody is taking the cash. Now they know if they take the cash and they put it on as a cash sale, someone's going to say, "Hey, this is whatever they paid, $500. Hey, this is short $500." So instead, they say they picked it up and they put it on their account, and somebody takes the cash. So the question here is, where is the missing cash, and how did this happen? And these are the questions. So, they obviously were given a receipt that shows that it was paid for in cash. So what we probably have to do is go through and look at the will call, how they actually operate and what happens. And you'll also probably go to that date and see if there was a over on the cash deposit. It could be just a clerical error. Someone puts it in as a accounts receivable, and oh gee, here the bank, we made the deposit in the bank, it was $500. We had $500 more than we should have. So it could be check the deposit for the bank. But you would probably also want to look at the one thing you want to look at is the controls over the will call. that, if somebody is paying cash and it's going in as an accounts receivable, it's possible that there's a problem with the will call area as far as how they're handling people coming in. And two, whenever you run into something like this, even if it's an innocent mistake, and it could be somebody, I put it in as an accounts receivable, it went in with the cash was, $500 over or whatever. The fact that it happened is evidence that there could be a problem in that area as far as, what am I doing here? That there could be a problem with the controls over the will call area. All right, question on that? Okay, I'm going to turn my back, and if any of you are still here, I'm going to bring up another chapter. Now, okay, so let's go ahead and save that, and I'll put a drop for that in Blackboard, and we might do more with this next week. But certainly next week we'd have the practice exam and the it will probably start on the next chapter. I think the next chapter we'll do is inventory. That's kind of a big one. How's this quarter over? We're like what, week 14, I think? I think we have what, 14, 15, 16, and then 17 I think is final. Okay, so we're getting near it. By the way, I think I told you guys this, maybe I didn't. We're not going to have a comprehensive final. It's just going to be just like we've been doing, finish up with the chapters, and I'll figure out what we're going to finish up here. But we're not going to have an overall final thing. All right, questions?
No.
Okay, well, I'll go ahead and put that in there. This will be due a week from, well, it'll be due on the 10th.
Is it a handout?
Yeah, this will be the chapter. Oh, I can do the MedTrans too. So MedTrans and the chapter 11 handout will be on there. The MedTrans is just, one sentence is fine. I'll write that down. And we'll have practice exam next week, and then we'll have I'll send out the exam then too. And we'll start it on the next chapter, which is going to be inventory. Okay. Any questions? And by the way, go ahead.
Oh, so we have class on the next week on the 7th, December 7th. And then do we have class the week after that on the 14th?
I think so. Let me.
Okay.
I thought. Oh, you're right. See, I saw this holiday closing starts. I thought that was the end of the semester, or the end of the, so actually it ends a week earlier. Final exams on the 18th. So what is it? So next week is what the 7th? Let's take a look here. See how many classes we have left. We only have 2 classes left. I thought I had another week. Oh well, I'll figure it out. Maybe I'll do. I think maybe I'll combine the accounts receivable with the inventory, and we'll just have one test on week. You'll turn in on the week of the 14th. I'm glad you said that. Because I was when I saw this holidays closing stars, it didn't occur to me that you know that was something different. So okay, well, very good. Yes, we only have. I'm very glad you said that. Okay, so next week, here's a new plan. Next week we'll go over a little bit over inventory, and it won't be too much. A lot of it is connects up with the accounts receivable stuff, anyways. A little bit with the receiving department, not much else. So anyway, I'll put those two together and do a test. So we'll have a test on accounts receivable, and inventory will be the last test, and you'll know exactly what's on it next class. Sorry about that. Now any questions or answers? Okay. Well, sorry about that. And yeah, so next class we'll go a little bit into inventory, just because it's in auditing, you'd be surprised, like a lot of times in auditing, the inventory will eat up half the audit, just because a lot of times for some companies it's just so big. That's the way it goes. So anyway, but we'll cover that next class, and yeah, it'll be so our last test will be the accounts receivable and the inventory. Any questions? I apologize again. I thought we had an extra week there. All right. Well, I will see you guys next week.
Thank you very much, Professor. Good night.
Guys. Have a good evening.